Today, I want to talk about the role of luck and bad luck in trading. Do they exist? Yes, they do. I'm going to show you how and what you can do about it. So you must think that if your trading strategy is profitable on paper, it must necessarily make you money, right? Well, not necessarily. And that's where the math behind trading gets both fascinating and frustrating. Imagine this. You know you have a good trading strategy and you trade it seriously, and yet for weeks, even months, you do not make a dime. Even worse, you lose money. And the reason could be not because of a mistake on your part, or not because the market has it in for you, but simply because of luck. Or rather, I should say bad luck. And the reverse is just as true. An objectively losing strategy with a negative expectancy can sometimes make you believe that you found the Holy Grail, simply because luck decided to smile on you. Temporarily. And it turns out that understanding luck and bad luck can literally save your account and years of hard work. Alright, so let's get into the explanations. When we start trading, we're often told you need to master your plan, follow your strategy, control your emotions, and for sure success will come. And that's true. Partly, at least. But what no one tells you is that there is an invisible force that no trader can escape: randomness. You can have the best strategy in the world, with precise setups, perfect money management, solid statistics, and still experience a streak of absurd, almost unfair losses. And in those moments, many traders question themselves, change their methods, or panic. And this is what's called the trader's cycle of doom. Yet, what they're going through is nothing exceptional. It's just variance. That natural oscillations between good and bad streaks that even the best traders experience. But if your brain doesn't understand and accept variance, it will hate that. It will want to explain and control everything. It will believe that a loss comes from a mistake and that a win comes from merit. Even worse, a loss will hurt your ego and a win will feed your ego. As a result, we completely underestimate the weight of luck in our performance. Is this illusion of control that pushes so many traders to abandon a potentially profitable strategy just because they've had a losing streak. And conversely, some keep trading a losing strategy simply because luck made them believe that they were good. So, before you ditch a strategy or judge yourself, simply ask, what if it wasn't me, but just a variance? And I'll show you what variance looks like on your trading account in a short moment. But before that, you need to understand the difference between expectancy and variance, which are two key concepts in trading. They're two words that we often encounter in statistics, but quickly forget to apply seriously in trading. Expectancy is the average of what your strategy is supposed to earn in the long term. If your reward to risk ratio and your win rate are good, then your expectancy is positive. That means on paper, your strategy should make money over time. But be very careful. That doesn't mean that you'll make money right away, because between theory and reality, there is variance. Variance is that unpredictable part, that statistical noise, which makes short-term results completely deviate from expectations. A very famous game that would have an expectancy of 0 would be to play heads and tails. If I choose heads and we flip a coin, and it falls on heads, I get $1, but if it's tails, then I give you $1. If we keep playing this game over the long run, then the expectancy is 0. I'm not supposed to make any money, and you're not supposed to make any money because the odds are 50-50, and if the reward to risk ratio is 1-to-1, then that brings the expectancy to 0. However, over a small amount of coin tosses, there might not be 50% of heads and 50% of tails. So I might lose money or earn money over a very small amount of tosses. And what causes that is variance. Now let's see what variance might look like on your trading account. Okay, so here I have an equity curve simulator, or in other words, a Monte Carlo simulation, which is a program that reproduces hundreds of random trade sequences while respecting a strategy's statistics. So I enter a specific win rate, a specific reward to risk ratio, the number of trades that I want to generate, and the number of lines. And each line or each curve represents a different trader's life, if I might say, that is subject to the whims of luck and bad luck. So let's assume that we have a profitable strategy on paper with a win rate of 50%, but a reward to risk ratio of 1.35. So that means it's a positive, it's a strategy that has a positive expectancy, because half of the time it will lose 1, but the other half of the time it will make 1.35. We will generate 200 trades and 100 lines. as if there were 100 traders trading a strategy with such statistics. On each trade, we will risk 1% of our capital, which will be at first, we'll start with 1,000 euros. And I'll click on Start Simulation. Let's go. Now, as we can see, over these 100 traders' lives, they all have very different results. Some of them have very good results and started with 1,000 euros and after 200 trades ended up with 2,200 euros or dollars, whatever. So they made 120% of returns. While on the other end of the spectrum, there are traders that are barely in profits with only 40 euros or $40. So they only made 4% return after 200 trades. And every time I make a simulation, I get different results because all of these traders experience luck and bad lucks in different ways every time. Here we can see that after 200 trades, some traders have actually lost money. Look at this blue curve here. The guy is actually experiencing a big drawdown of minus 24%, though, as a reminder, the strategy on paper is supposed to make money because it has a positive expectancy. Here, once again, we have traders that have made a very good amount of money with almost 100% return. Some hover around the average, which is the black curve, which is what the strategy is supposed to make in theory. But we can see that in reality, we get very different results from minus 25% all the way up to plus 100%. So some of these curves are very good and others are catastrophic, but they all stem from the same strategy with the same hit rate and the same reward to risk ratio. So of course, after 200 trades or even after 100 trades or 150 or even less, the traders at the bottom here who keep seeing their capital go down, they will want to ditch their strategy because they will think that something is wrong with it and it's obviously not making any money after 200 trades. And that's exactly how you can have bad luck in your trading. And the worst thing is that each trader has no control over which curve he or she will get. This is just pure randomness. Either the order of trades will be win, 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 loss, loss, win, 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 loss, 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 etc. And you will get one specific curve, or it will be loss, 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 win, win, loss, 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 whatever, and you will get a completely different curve. But on theory, you have the same win rate in both cases. As I said, it's fascinating and terrifying at the same time, because you can follow a winning strategy, but if your series begins during an unlucky phase, you can lose money for months before your edge really shows up. And if you quit at that moment, as many traders do, then you'll have left right before the curve eventually turned back up. That's exactly what's called the variance trap. We judge a strategy over a short period and we think it's bad, when in reality, it's just bad luck working against us. Because look at what happens if I now generate more trades. So let's say not 200 trades, but 1,000 trades. I'll start the simulation, and now all of the 100 traders are all in profits because the theoretical edge of the strategy has finally materialized in reality. So variance played a role in the short term, but the short term might seem long for our human brain because it might take months to get up to 200 or more trades before the edge finally turns up. But over a large enough sample of trades, if a strategy truly has an edge, then it's inevitable it will eventually show up. Now, still, after 1,000 trades, the results are very different from one trader to another. One trader up here, has multiplied his initial equity by 14, while another is only, if I might say, up. He's up like roughly 100%. While another is up 1,300%. So now you see how bad luck can affect your trading account even though your strategy is actually very good. Now let's check how luck can also play a role in trading. Here I generated a losing strategy. As you can see, it has a 50% win rate, but a win-loss ratio of 0.9. Basically, it makes less money when it wins than what it loses on its losing trades. I generated 200 trades and 100 equity curves. And the results are very surprising as well, because roughly half of these traders are profitable after 200 trades, despite the fact that they are trading with a losing strategy in theory. We even have one trader up there with the blue line that is making a 36% return, though the strategy clearly has a negative expectancy or expectation. In other words, it has a negative edge, and over the long run, it will lose money, but over the short term, because variance plays in, and in that case, luck plays a role, some of these traders are making money with a bad strategy. And that's often where the most dangerous illusions are born. Traders who succeed for a few weeks or a few months believe that they have a gift or that they found the holy strategy. But sooner or later, if you trade with a strategy that has a negative edge, statistical reality will reclaim its place, and eventually everything will start collapsing. The lesson is that in trading, neither short-term success nor short-term failure mean much. Only repetition over hundreds, even thousands of trades can tell you whether your edge is real or if you were just in a lucky phase. And what you need to do to get the best chances at knowing whether the strategy that you're currently trading or that you plan to trade actually has an edge or not is to backtest it over a large enough sample of trades. And you can actually do that in just minutes. On Upside.com, you can just create a strategy, choose the assets on which you want to test it, and then there is no need to code anything. You just type in the rules of your strategy, the entry rules, the exit rules. You can adjust some of the settings in terms of backtest period and risk management. Then click the backtest button, and in a few minutes, you will have a complete backtest with all the trades that your strategy would have taken. And if the number of trades taken in the backtest is large enough, then you get a very good idea of whether the strategy is profitable or not. Since we know that over the next 200 trades, luck or bad luck could play a role in our actual results, why not backtest the strategy to see what the results would have been over the last 1,000 trades? And that's precisely what you can do to minimize the impact of luck or bad luck, at least on your trading psychology. Because once you've properly backtested your strategy and you've seen that it has a positive expectancy over a large number of trades, then you won't be worried the next time you enter a losing streak or the next time you're not profitable over 50 or 100 or more trades. So though you cannot control the actual variance over your next few trades, you can control what you will do about it, and whether, like most traders, you would ditch strategies that are actually good, or you would actually get too confident about strategies that haven't been tested properly yet. All right, I hope you enjoyed this video. I'll see you in the next one. Bye.